Many retirees assume that once they stop working, their tax situation becomes simple. Income slows down, expenses become more predictable, and the idea of taxes fades into the background. In reality, retirement taxes often become more complex, not because the rules are harsher, but because income comes from many different places. Social security, pensions, retirement account withdrawals, investment income, and occasional part time work all interact with the tax code in ways that are not always obvious. That is why even small changes to tax rules can have an outsized impact for seniors, especially those living on fixed or semi fixed incomes. For tax years beginning in 2025, the Internal Revenue Service introduced a temporary adjustment that directly affects taxpayers aged 65 and older. This change has been discussed quietly, without major headlines, and without the kind of public awareness that usually surrounds major tax reforms. Yet for millions of retirees, it has the potential to meaningfully reduce taxable income over a limited period of time. This is not a permanent rule, and it is not automatic. It is a deduction that must be understood and properly claimed in order to have any effect. The adjustment is commonly referred to as a senior bonus deduction or an enhanced deduction for older taxpayers. The name itself is less important than how it works. The key concept is that this deduction does not replace existing deductions. Instead, it adds to them. For seniors who already qualify for the standard deduction and the additional age-based deduction, this new provision stacks on top, increasing the amount of income that can be shielded from federal taxation. It is important to clarify what this deduction is and what it is not. It is not a tax credit. A credit reduces tax owed dollar for dollar. A deduction reduces the amount of income that is subject to tax. That difference matters. A $6,000 deduction does not put $6,000 into a retiree's pocket. Instead, it lowers taxable income by that amount, which then reduces the tax owed based on the individual's tax bracket. Even so, for many seniors, especially those in lower to middle brackets, the resulting savings can still be meaningful. For a single taxpayer aged 65 or older, the bonus deduction is up to $6,000 per year. For married couples filing jointly, where both spouses meet the age requirement, the bonus can reach $12,000. These amounts apply on a per-person basis, not per household, which is a critical detail that many people overlook. If only one spouse qualifies by age, only one bonus deduction applies. To understand why this matters, it helps to look at how deductions accumulate. A single filer over the age of 65 already qualifies for the standard deduction, which is adjusted annually for inflation. On top of that, there is an additional age-based deduction simply for being over 65. The new senior bonus deduction is added after both of those. When combined, the total amount of income protected from federal tax can approach $24,000 for some single filers, depending on the exact figures for that tax year. For married couples filing jointly, the effect is even more pronounced. The standard deduction for married couples is already higher than for single filers. When both spouses are over 65, each qualifies for an age-based addition. Adding the new senior bonus deduction for each spouse can push the total protected income into the $40,000 range. For retirees living on pensions, Social Security, and modest withdrawals, this level of protection can significantly reduce or even eliminate federal income tax liability in some years. However, this benefit is not unlimited. It is designed to focus on low and middle income seniors, not high earners. As income rises, the bonus deduction begins to phase out. For single filers, the phase out begins when income exceeds $75,000 and ends completely at $175,000. For married couples filing jointly, the phase out starts at $150,000 and ends at $250,000. The reduction happens gradually, not all at once. For every $1,000 of income above the threshold, the bonus deduction is reduced by $60. This means that many taxpayers in the phase-out range still qualify for a partial deduction. Partial does not mean insignificant. Even a reduced deduction can still lower tax liability by hundreds or thousands of dollars depending on the tax bracket. Consider a single retiree with an income of $60,000. This taxpayer is below the phase-out threshold and may qualify for the full $6,000 bonus deduction. If that same retiree earns $78,000, they are $3,000 above the threshold. The deduction would be reduced by approximately $180, leaving a bonus deduction of around $5,820. The benefit shrinks, but it does not disappear immediately. For married couples, the same logic applies. A couple with joint income of $145,000 may qualify for the full $12,000 bonus. At $165,000, the reduction would be modest. Even at higher levels within the phase-out range, a meaningful portion of the deduction can remain. The key is understanding that eligibility is not binary until the upper limit is reached. Another important feature of this deduction is flexibility. Unlike many tax benefits, it applies whether a taxpayer itemizes deductions or takes the standard deduction. This is unusual. The tax code often forces taxpayers to choose between one approach or the other. In this case, seniors may still qualify for the bonus deduction regardless of which method they use. That makes it relevant for retirees with high medical expenses, charitable contributions, or other itemizable costs, as well as for those who prefer simplicity. The deduction applies only to tax years 2025 through 2028. This 4-year window is critical. Unless extended by future legislation, the benefit expires after the 2028 tax year. Temporary provisions like this change how planning should be approached. Timing matters more when rules have an expiration date. Income decisions that might be neutral in other years can have different consequences within a limited window. This does not mean retirees should rush into financial moves or avoid necessary income. It means they should be aware of how income timing affects deductions. Large retirement account withdrawals, capital gains from selling investments, Roth conversions, or the sale of property can all push income into higher ranges. When those events occur during a limited benefit window, they can reduce or eliminate eligibility for the bonus deduction in that year. Claiming the deduction correctly is just as important as qualifying for it. Many people assume tax software or preparers automatically catch every available benefit. That assumption is often wrong. Software only works with the information entered. Preparers rely on the accuracy of the details provided to them. Understanding the deduction helps ensure it is not missed. When filing, seniors typically use Form 1040 or the simplified version designed for older taxpayers. Indicating age correctly is essential because the age checkbox triggers age-related deductions. For married couples, both spouses' ages must be properly reported to claim both bonuses. The calculation itself is performed on the appropriate schedule, where the bonus amount and any phase-out reduction are applied based on income. Organization plays a major role in accurate filing. Retirement income often comes from multiple sources: Social Security statements, pension forms, retirement account distributions, interest and dividend statements, and records of part-time income all contribute to the final income figure. That figure determines eligibility and reduction levels. Being organized reduces errors and prevents overpayment. There is also widespread confusion about how this deduction interacts with Social Security taxation. Some online discussions claim that the bonus deduction eliminates taxes on Social Security benefits. That claim is false. The rules governing Social Security taxation have not changed. What can change is overall taxable income. When deductions are large enough and income is modest, total tax owed may fall to zero, which can create the impression that Social Security has become tax-free. In reality, it is the interaction of deductions and income that produces that result, not a direct exemption. Understanding the real value of the deduction requires translating it into dollars saved. The amount saved depends on the tax bracket. For someone in the 12% bracket, a $6,000 deduction may reduce tax by about $720. In a higher bracket, the savings increase. For married couples eligible for the full $12,000 bonus, the combined savings can exceed $2,000 in some cases. For retirees, that is not trivial. It can cover medical costs, insurance premiums, or provide a buffer against unexpected expenses. With any new benefit aimed at seniors, scams inevitably follow. Fraudsters often exploit confusion by claiming to help unlock deductions for a fee or by impersonating government agencies. The IRS does not charge fees to access deductions, does not initiate contact through unsolicited calls or messages, and does not require immediate action under threat. Any communication demanding urgency or personal information should be treated with caution. The most effective approach is calm accuracy. Write down the key numbers, understand the age requirement, the income thresholds, the phase-out formula, and the 4-year time limit. Check that age status is correctly reported. Review the return to confirm the deduction was applied. Awareness, not panic, is what protects money. This deduction is not a loophole, a trick, or a guaranteed windfall. It is a temporary adjustment within the existing tax framework. It rewards attention and accuracy. Those who understand it and claim it properly may reduce their tax burden during the window it is available. Those who ignore it may pay more than required, not because they did anything wrong, but because they did not use what the law allowed. The question is not whether this deduction exists. It does. The real question is whether taxpayers will recognize it, understand it, and claim it correctly during the limited time it is available. That decision determines whether the benefit stays theoretical or becomes real.